Warning, refiners refuse to purchase 90% silver. Credit freeze, maxed out credit. The words no wholesaler wants to hear. Yet this week, they became reality. Silver closed at $103 in New York, $115 in Shanghai. The gap widening, the system breaking. But here's what they're not telling the public. Major refiners are going no bid on constitutional silver, the most trusted form of precious metal in American history, being rejected, while dealers sell out of everything else. The CEO of one of America's largest bullion firms just sent a letter. 2 words: absolute circus, credit lines maxed, inventory dumping, and aircraft carriers moving into position. The collision is imminent, but the question nobody's asking is, why are they refusing the one thing that could save them? Welcome. Welcome to John Analyst. You've just entered a briefing room, not an entertainment channel, a strategic economic intelligence platform. Now, I need to ask you something. The way a concerned colleague might ask a seasoned professional over coffee, have you subscribed yet? I know. You're probably thinking another channel asking for subscriptions. But here's the difference. We don't chase trends here. We decode systems before they collapse. Think of this subscription as your seat at the executive briefing table. The table where the real conversations happen. Before the headlines, before the panic, before the public even realizes what's breaking. So do me a favor, click that subscribe button. Not for me, but for yourself. Because what we're about to uncover in the next few minutes could redefine how you view credit, currency, and crisis. And one more thing, drop a comment below. Tell me where you're watching this from. New York, London, Singapore, Mumbai, Dipalpur. I'm genuinely curious. Because this crisis, it doesn't respect borders. Now, let's begin. The credit freeze isn't coming. It's already here, and the evidence is hiding in plain sight. It is Saturday, January 24th, 2026. The markets are closed. The ticker tape has stopped moving, but the anxiety in the financial system is vibrating at a frequency that could shatter glass. Silver closed the week at $103 per ounce in the United States. In China, on the Shanghai Futures Exchange, $115, a $12 gap. An arbitrage vacuum, a crack in the global pricing mechanism. Gold is sitting at the doorstep of $5,000, the psychological barrier that validates everything, the number that wakes up the general public, the number that makes the nightly news. But while the price action is historic, it is the invisible collapse happening behind the scenes that should concern every serious investor. We have obtained a letter from Dr. Tyler Wall, the Chief Executive Officer of SD Bullion. For those unfamiliar with the industry, SD Bullion is not a small player. They are one of the 3 largest online precious metals retailers in the United States. They move massive volume. They have direct relationships with refiners, wholesalers, and mints. They have their finger on the pulse of the wholesale market. And Dr. Wall does not mince words. He describes the current state of the precious metals wholesale market with 2 words: absolute circus. When the CEO of a major financial firm calls his own industry a circus, you stop and listen. He's not talking about clowns and elephants. He's talking about chaos. He is talking about a breakdown in the orderly function of trade. But the most terrifying sentence in his letter is not the headline. It is the explanation. He writes, "It's becoming increasingly obvious that many large participants are either at or very near their maximum credit terms." Maximum credit terms. Maximum credit terms. Let that phrase settle in your mind. To understand why this is catastrophic, you must understand how the bullion business actually operates. It is a business built on borrowed money. Wholesalers do not buy silver with cash sitting in their checking accounts. They use revolving credit lines provided by major banks. The mechanism works like this. A wholesaler borrows $50 million from a bank. They purchase silver from the refiner. They ship it to the retailer. The retailer pays. The wholesaler pays. Back the loan. The cycle repeats. It is a high-volume, low-margin conveyor belt. Speed and efficiency are everything. But here's the trap. Those credit lines are fixed in dollar amounts, not ounce amounts. This distinction is critical. When silver was trading at $25 per ounce, a $10 million credit line allowed a wholesaler to finance 400,000 ounces of silver. That is substantial inventory. That keeps the conveyor belt moving smoothly. But today, with silver trading at $103 per ounce, that same $10 million credit line only buys approximately 97,000 ounces. The purchasing power of the wholesaler has collapsed by 75%. Not because they lost money, not because they made bad trades, but because the price of the asset they deal in rose faster than the bank's willingness to lend. They are maxed out. They have hit the ceiling of their corporate credit cards. And because they are maxed out, they cannot buy new inventory. This explains the paradox we are witnessing across the industry. The demand from the public is at record highs. People are walking into coin shops, waving cash, begging for metal. But the shelves are going empty, not because the silver does not exist, but because the wholesalers physically cannot finance the restock. The pipe has shrunk. The infrastructure designed for $25 silver cannot support $103 silver. The system was never stress tested for this scenario. Dr. Wall mentions another critical factor in his letter. Money velocity is extremely high. In traditional economics, velocity is usually a positive indicator. It means a booming economy, money changing hands rapidly. But in a logistics system with finite capacity, extreme velocity becomes a disaster. It causes friction. It causes heat. It causes critical parts to seize up. Transactions are happening faster than the settlement systems can clear them. Dealers are selling inventory before they have paid for it. Wholesalers are shipping metal before the refiners have even cast it. The entire supply chain is redlining, running beyond its operational limits. And when systems redline, they break. We are watching that break happen in real time. The question is not whether the system can handle $103 silver. The question is already answered. It cannot. The credit freeze is not a future threat. It is present reality. The wholesalers are maxed out. The banks are not expanding credit lines proportionally, and the gap between price and infrastructure capacity is widening every single day. But this credit collapse reveals something even more disturbing, an anomaly that defies all conventional market logic, an anomaly involving the most trusted form of silver in American history, constitutional silver. Pre-1964 dimes, quarters, and half dollars, 90% silver, government minted, legal tender, the ultimate doomsday money, and refiners are refusing to buy it, going no bid on the very asset that should command the highest premium in a crisis. Why? The answer lies in the intersection of time, credit, and chemistry, and it represents the greatest buying opportunity most investors will never understand. There is a rule in markets that rarely gets violated. When demand exceeds supply, price rises. When an asset becomes scarce, premiums expand. When fear enters the system, tangible assets become king. This is economics at its most fundamental level. Supply and demand, scarcity and value, fear and flight to safety. But right now, in the precious metals wholesale market, that rule is being shattered. We are witnessing something that should not exist in a rational market, a complete inversion of logic. Let me paint the picture clearly. Silver eagles are sold out across the country. Maple leafs are back-ordered for weeks. Modern bullion bars are commanding premiums of 15 to 20% over spot. Retail customers are waiting in line. Dealers are turning people away. The shortage is visible. The panic is measurable. And yet, at the same time, wholesalers and refiners are going no bid on 90% constitutional silver. No bid. That means they are refusing to purchase it. They are turning away sellers. They are rejecting the very metal that built American commerce. Pre-1964 dimes, quarters, half dollars, Roosevelt, Washington, Franklin, Kennedy, coins that circulated in American pockets for generations. Coins that contain 90% silver and 10% copper. Coins that represent the closest thing to constitutional money this nation has left. And the wholesale market is saying, we don't want it. Dr. Wall confirms this in his letter. He writes, what really stood out was the complete lack of bids from many refiners and large wholesalers on 90% silver. He goes further. He notes that despite record demand for silver overall, they are seeing secondary products trade under spot. Under spot. Let me translate that for those unfamiliar with the terminology. Silver is trading at $103 per ounce on the futures exchange, but wholesalers are so desperate to move their constitutional silver that they are willing to sell it for less than the paper price. $95, $90, perhaps even lower in private transactions. They are dumping the most recognizable, most trusted, most historically significant silver coinage in the world at a discount, while simultaneously charging massive premiums for newly minted eagles. This is not just unusual. This is a market dislocation of historic proportions. So the question becomes obvious. Why? Has constitutional silver lost its silver content? No. A pre-64 quarter still contains 0.18084 troy ounces of pure silver. The metal has not vanished. Has constitutional silver lost its legal tender status? No. It remains official United States currency. Has the public lost trust in constitutional silver? Absolutely not. In survival forums and preparedness communities, junk silver is considered the ultimate barter tool. So if the metal is real, if the trust is intact, if the demand exists, why are refiners rejecting it? The answer is not found in the metal itself. The answer is found in time. To a wholesaler or refiner operating on maxed out credit, Constitutional silver is dirty, not literally dirty, but chemically impure. It is 90% silver and 10% copper. You cannot sell a bag of pre-64 dimes to Samsung. You cannot ship constitutional quarters to a solar panel manufacturer. Industrial users require 0.999 fine silver. They require purity. They require standardization. So to convert constitutional silver into industrial inventory, you must send it to a refinery. You must melt it down. You must separate the copper from the silver. You must cast it into new bars that meet industrial specifications. That process takes time, 2 weeks minimum, 4 weeks depending on the refinery backlog. In some cases, 6 weeks. And here is where the credit trap closes like a vice. In a normal market, 4 weeks is nothing, a minor inconvenience, a standard processing timeline. But we are not in a normal market. We are in a liquidity crisis. The wholesalers are maxed out on their credit lines. They are paying exorbitant interest rates on borrowed money. They are facing daily margin calls from the futures exchange. They are hemorrhaging cash just to stay operational. They need liquidity now, not in 4 weeks, not in 2 weeks. Now, they need to turn over their inventory in 24 hours, not 24 days. They cannot afford to have millions of dollars tied up in a smelter, sitting idle, earning nothing. While the interest meter runs and the margin calls arrive, every day that metal sits in the refining queue is another day of bleeding cash, another day closer to insolvency, another day the bank could pull the credit line. So they make a decision, a brutal, economically rational decision. They stop buying constitutional silver. They go no bid. And for the inventory they already hold, they dump it. They sell it at a loss. They take the hit, because a small loss today is better than total liquidation tomorrow. This is what Dr. Wall means when he describes a liquidity discount. The wholesalers are not valuing the metal. They are valuing speed. They are valuing cash flow. They are throwing away fundamental value to secure operational survival. They are selling the baby with the bathwater because they are drowning. But here is where the opportunity emerges. You, the private investor, are not a wholesaler. You do not have a $50 million credit line with JP Morgan that is about to explode. You do not have margin calls arriving every morning. You do not need to refine the silver to sell it to Samsung. You are a long-term holder. You are holding for currency collapse. You are holding for systemic failure. To you, silver is silver. 90% constitutional silver at a discount is one of the greatest asymmetric opportunities in modern financial history. You are buying the exact asset that the smart money is forced to liquidate. Not because it is worthless, but because their balance sheet is broken. This is classic distressed selling. And distressed selling creates distorted prices. Prices that do not reflect fundamental value. Prices that reflect desperation. Warren Buffett built his fortune on one principle. Be greedy when others are fearful. Be liquid when others are desperate. Right now, the wholesalers are desperate, and constitutional silver is being offered at prices that will never be seen again. Once this liquidity crisis resolves, the no bid is temporary, the discount is temporary. The opportunity is closing. There's a financial instrument that most people never think about. It operates in the background of every major commodity market, invisible to the public, essential to the professionals. It is called a hedge, and right now, it is killing the precious metals wholesale industry. Let me explain how this works. Imagine you are a bullion wholesaler. You purchase $1 million worth of silver from a refiner on Monday. You plan to sell it to retail dealers by Friday. But between Monday and Friday, the price of silver could move. It could rise. It could fall. If it falls 10%, you just lost $100,000. That loss could wipe out your entire profit margin for the quarter. So what do? You hedge. You go to the futures market, and you open a short position equal to your physical inventory. If you own 100,000 ounces of physical silver, you short 100,000 ounces on the COMEX. Now you are neutral. If the price drops, you lose money on your physical inventory, but you make money on your short position. The gains and losses offset. You're protected. This is standard practice in the commodity business. Every major wholesaler does it. Every professional dealer understands it. It is risk management at its most basic level. But there is a problem that only reveals itself when prices move vertically. When silver was trading at $25 per ounce, hedging was cheap. The margin requirements were low. The volatility was manageable. The cost of maintaining a short position was a minor line item on the balance sheet. But silver is no longer at $25. It is at $103, and it got there in a matter of weeks. A violent, parabolic, historic move, and every single wholesaler who hedged their inventory is now trapped. Their short positions are bleeding, massively, catastrophically. Let me give you the mathematics. A wholesaler shorts 100,000 ounces at $25. Silver rallies to $103. That is a $78 move against their position. $78 multiplied by 100,000 ounces equals $7.8 million in losses. $7.8 million, on a hedge that was supposed to protect them. But here's the cruel twist. Those losses are not theoretical. They are realized daily through margin calls. Every single day, the futures exchange calculates the mark-to-market value of every open position. If your position is losing money, you receive a margin call. You must wire cash to the exchange immediately. If you do not, your position is liquidated, your account is closed, you're out of business. So the wholesalers are faced with an impossible choice. Option 1, pay the margin calls and stay hedged. But paying the margin calls drains the cash reserves. The same cash reserves needed to buy new inventory. The same cash reserves needed to pay employees. The same cash reserves needed to service debt. Option 2, close the hedge and go naked. But closing the hedge means realizing the full loss immediately. $7.8 million gone, vaporized. And now you own 100,000 ounces of unhedged silver. If the price drops tomorrow, you absorb the entire loss with no protection. Option 3, liquidate the physical inventory. Sell the silver, use the cash to close the losing hedge, stop the bleeding, survive another day. This is the choice most wholesalers are making. They are choosing survival. And Dr. Wall confirms this explicitly in his letter. He writes, "The cost to maintain hedging accounts has skyrocketed, which further limits how much inventory firms can carry on their shelves. This is the nail in the coffin. The hedging trap has closed. The wholesalers cannot afford to stay hedged. They cannot afford to go unhedged, so they are forced into the only remaining option: liquidation. Distressed liquidation, selling inventory not because they want to, but because the mathematics of survival demand it. Now combine this with the two forces we have already discussed. Force 1, the credit lines are maxed out. The purchasing power per dollar borrowed has collapsed by 75%. Wholesalers cannot finance new inventory. Force 2, the velocity of transactions is exceeding settlement capacity. The system is clogged, payments are delayed, deliveries are backlogged, and now, Force 3, the hedging costs are draining operational capital. The margin calls are bleeding the cash that should be used for restocking. 3 forces, 3 simultaneous pressures, 3 points of failure converging on the same business model. This is what Dr. Wall means when he calls it an absolute circus. It is not hyperbole. It is clinical diagnosis. The wholesale market is in systemic failure. And when a market enters systemic failure, rational behavior breaks down. We see irrational outcomes. Outcomes like wholesalers dumping inventory in a shortage. Outcomes like refiners going no bid on constitutional silver. Outcomes like dealers selling below spot while retail premiums hit 20%. Dr. Wall describes the sales volume as a complete wild card. He cannot predict how much inventory SD bullion will move. He cannot forecast demand. He cannot model supply. The variables have become too chaotic. The market has become too volatile. And when markets become wild cards, institutions leave. Risk managers pull capital. Banks tighten credit. Hedge funds go flat. The professionals exit. And the market is left to those who can tolerate chaos, those who have cash and no debt, those who understand that chaos creates opportunity. Dr. Wall writes something else in his letter, something that should send a chill down the spine of every wholesaler still operating on borrowed money. He says, a lack of available financing is forcing other wholesalers to dump inventory as quickly as they get it. Dump inventory as quickly as they get it. Think about that phrase. These are not sophisticated profit-taking strategies. These are not calculated market timing decisions. This is panic. This is survival mode. A wholesaler receives a shipment of silver on Monday. By Tuesday, it is gone, sold, liquidated. Not because the price is attractive, not because the buyer is offering a premium, but because the wholesaler has a debt payment due on Wednesday. And if that payment is not made, the bank pulls the credit line. The business collapses. This is distressed selling in its purest form. And distressed selling creates the ultimate opportunity for the buyer with patience, the buyer with cash, the buyer who does not need to flip the inventory in 24 hours. Because here is the mathematical certainty. This dump is finite. Once the wholesalers sell their current inventory, they cannot replace it. The credit freeze prevents restocking. The hedging trap prevents risk-taking. The velocity overload prevents operational efficiency. So the dump we are witnessing this weekend is the final clearing of inventory from the weak hands, the overleveraged, the poorly hedged, the desperate. They are transferring their silver to the strong hands, to SD bullion, to sovereign wealth funds, to private investors who understand what is happening. And once that transfer is complete, the selling stops, abruptly, permanently. And when the selling stops, there is no offer, only demand, only buyers, only panic. The price does not rise gradually. It gaps, it jumps, it skips entire levels. Because the inventory that was absorbing the demand is gone, sold to those who will not sell it back. Not at $103, not at $115, perhaps not at any price. This is the setup. Three forces crushing the wholesalers: distressed selling creating temporary discounts, and a finite window before the inventory disappears forever. But there is a fourth force entering the equation, a force that has nothing to do with credit or hedging or logistics, a force that operates outside the financial system entirely: geopolitical risk, war, and it is arriving this weekend. This is survival mode. A wholesaler receives a shipment of silver on Monday. By Tuesday, it is gone, sold, liquidated, not because the price is attractive, not because the buyer is offering a premium, but because the wholesaler has a debt payment due on Wednesday. And if that payment is not made, the bank pulls the credit line, the business collapses. This is distressed selling in its purest form. And distressed selling creates the ultimate opportunity for the buyer with patience, the buyer with cash, the buyer who does not need to flip the inventory in 24 hours. Because here is the mathematical certainty. This dump is finite. Once the wholesalers sell their current inventory, they cannot replace it. The credit freeze prevents restocking. The hedging trap prevents risk-taking. The velocity overload prevents operational efficiency. So the dump we are witnessing this weekend is the final clearing of inventory from the weak hands, the overleveraged, the poorly hedged, the desperate. They are transferring their silver to the strong hands, to SD bullion, to sovereign wealth funds, to private investors who understand what is happening. And once that transfer is complete, the selling stops, abruptly, permanently. And when the selling stops, there is no offer, only demand, only buyers, only panic. The price does not rise gradually, it gaps, it jumps, it skips entire levels, because the inventory that was absorbing the demand is gone, sold to those who will not sell it back, not at $103, not at $115, perhaps not at any price. This is the setup. Three forces crushing the wholesalers: distressed selling creating temporary discounts, and a finite window before the inventory disappears forever. But there is a fourth force entering the equation, a force that has nothing to do with credit or hedging or logistics, a force that operates outside the financial system entirely: geopolitical risk, war, and it is arriving this weekend. There's a moment in every market cycle where two opposing forces collide. One force pushing prices down, another force pulling prices up. Normally, these forces fight each other to a stalemate. The market oscillates. It finds equilibrium. It settles into a range. But occasionally, very occasionally, these opposing forces do not cancel each other out. Instead, they amplify each other. They create a paradox, a coiled spring compressed from both directions simultaneously. And when that spring releases, the result is not gradual movement, it is explosion. We are standing at that exact moment right now. On one side, we have financial stress forcing liquidation. The wholesalers are dumping inventory. The credit lines are maxed. The hedging accounts are bleeding. The system is in distress mode. This should be deflationary for prices. More supply hitting the market. Desperate sellers accepting lower bids. Classic distressed liquidation dynamics. But on the other side, we have geopolitical stress escalating by the hour. The Abraham Lincoln Carrier Strike Group has arrived in the CENTCOM region. This completes the largest United States military buildup in the Middle East in recorded history. Aircraft carriers do not deploy for diplomatic theater. They deploy because the probability of kinetic conflict has crossed a threshold that triggers automatic protocols. Protocols designed decades ago by strategists who understood one simple truth: war is inflationary. War requires deficit spending. War disrupts supply chains. War spikes the price of energy. War destroys currencies. And what serves as the ultimate hedge against war-driven inflation? Gold, silver, hard assets with no counterparty risk. So we have two forces: financial liquidation pushing prices down, geopolitical fear pulling prices up. And here is why this weekend is different from every other weekend in recent history. These two forces are not fighting each other. They are working together. Let me explain the mechanism. The wholesalers are dumping their current inventory at distressed prices. This creates temporary availability. It creates the illusion of supply. It gives retail buyers a brief window to acquire metal at near spot prices. But once that inventory is sold, it is gone, permanently. The credit freeze prevents the wholesalers from restocking. They cannot borrow more money to buy replacement inventory. They cannot afford the hedging costs. They cannot manage the velocity. So the dump is a one-time event, a liquidation sale with no restocking. Meanwhile, the geopolitical situation is driving new demand into the market. Investors who have never purchased silver before are suddenly searching for safe havens. Wealth managers who dismissed precious metals as relics are suddenly allocating capital. Institutions that relied on bonds and equities are suddenly questioning counterparty risk. The war premium is entering the market. And war premiums do not operate on gradual timelines. They operate on fear timelines. Fear moves fast. Fear does not wait for orderly markets. Fear Fear does not respect credit limits or hedging strategies. Fear buys now, at any price. So you have a collision approaching. Supply going to zero as distressed inventory clears and restocking becomes impossible. Demand going to infinity as geopolitical fear spreads, and safe haven buying accelerates. The collision point is Monday morning. But there is another factor magnifying this setup: the Shanghai premium. Silver closed in New York at $103. Silver closed in Shanghai at $115, a $12 gap. In normal markets, arbitrage eliminates gaps like this within hours. Traders buy in the cheap market, sell in the expensive market, pocket the spread. The gap closes, but this gap is not closing, it is widening. Why? Because the physical metal required to execute the arbitrage does not exist in sufficient quantity. Or more precisely, it exists, but it cannot move. The credit freeze has paralyzed the logistics. The wholesalers who would normally facilitate the arbitrage cannot finance the transaction. The refiners who would normally process the metal for shipment are backlogged for weeks. The dealers who would normally provide the liquidity are dumping inventory just to survive, so the gap persists. And as long as the gap persists, it acts as a magnet, economic gravity pulling the New York price toward the Shanghai price. $12 of pure arbitrage profit, sitting in plain sight, unreachable by institutions, but visible to every trader watching the screens. This creates psychological pressure. If you are a hedge fund manager sitting in London or New York, are you going to hold a short position over the weekend? Are you going to bet against silver while aircraft carriers move into combat zones? Are you going to trade against a $12 arbitrage gap? No. You are going to cover, you are going to close your short, you are going to get flat. Or if you are aggressive, you are going to get long. This is the weekend anxiety that drove Friday's close. A scramble for safety, a rush to neutralize risk before the weekend news cycle, and now we must discuss gold. Because gold is the validator. Gold is trading at $4,990, $10 below the 5,000 milestone. 5,000 is not just a number, it is a psychological threshold. It is the kind of number that makes the nightly news. It is the kind of number that wakes up the general public. When gold breaks 5,000, and it appears imminent, it validates the entire precious metals complex. It tells the world that fiat currencies are in terminal decline. It tells pension fund managers that their 60-40 portfolios are obsolete. It tells central banks that their monetary experiments have failed. And silver is the high beta sibling of gold. When gold walks, silver runs. When gold runs, silver sprints. If we apply the historical monetary ratio of 15-1, gold at 5,000 implies silver at $333. At 103, silver is still lagging. Silver is still the cheapest asset on the board relative to gold. This value gap, combined with the war premium, combined with the credit freeze, combined with the Shanghai arbitrage, creates a setup that traders call a gap and go. Let me explain what happens when the electronic markets open Sunday evening. The markets have been closed since Friday afternoon. During that closure, the news cycle has been dominated by military movements, uncertainty has built, fear has compounded, and buy orders have accumulated in the system. Those orders cannot be filled while the market is closed. The pressure builds behind a dam. When the market opens, the dam breaks. If there are more buy orders than sell orders, the price does not tick up gradually. It gaps. It jumps instantly. 103 becomes 108, 110, 115. It skips the prices in between. This is not theory. This is mechanical function. This is what happens when order imbalance meets illiquid conditions. And the conditions are profoundly illiquid. The wholesalers have dumped their inventory. The refiners are backlogged. The dealers are maxed on credit. There is no inventory buffer to absorb the demand. So the price must rise to a level where it forces metal out of hiding, to a level where private holders are willing to sell, to a level where the pain of holding short positions becomes unbearable. That level could be 120, 150, 200. Nobody knows. Because we're in price discovery mode, and price discovery in a broken market is chaotic. Dr. Wall calls it uncertainty. He says predicting volume is a complete wild card. That uncertainty is what terrifies institutional traders. They hate wild cards. They hate unpredictability. So they exit. They pull their capital. They go to cash. And when institutions exit, the market becomes even more illiquid, which makes the gap even more violent. This is the feedback loop. Fear creates illiquidity. Illiquidity creates gaps. Gaps create more fear. The loop accelerates. But here's the critical insight for the long-term holder. The gap is noise. The gap is theater. The gap is the market discovering what silver is actually worth. In a world where credit is frozen, where war is looming, where currencies are being debased, and where physical metal cannot move from west to east fast enough to satisfy demand. The fundamental equation has not changed. Silver is still the most undervalued monetary metal in human history. Gold at $5,000 tells us the dollar has lost 99% of its purchasing power since 1913. Silver at 103 is simply catching up to that debasement. It is not overvalued. It is still cheap, historically cheap, mathematically cheap, and the setup entering Monday confirms it. The wholesalers cannot restock. The refiners cannot process fast enough. The Shanghai premium cannot close. The geopolitical risk cannot be ignored. The credit system cannot support current prices. All roads lead to higher prices, not because of speculation, not because of hype, but because the infrastructure of the market has broken. And when infrastructure breaks, price must rise to a level that bypasses the broken infrastructure. A level where transactions happen peer to peer, cash for metal, no credit, no hedging, no intermediaries. That level is much higher than 103. This is not prediction. This is observation. The pieces are already in motion. The wholesalers are already liquidating. The carriers are already deployed. The gap is already $12. The only question remaining is whether you position yourself before the gap or chase it after. The window is closing. The circus is ending. And the rocket launch is imminent.